Hey everyone, Dale Anderson here. Hope you're well. Just wanted to give you a quick update on four or five reasons I believe the UK housing market will hold up despite the high mortgage rates in 2023. As mentioned before, I've been in property investment now for near on over 15 years. I've bought property myself, so I've seen the good and the bad side of the market, as well as the upside and the downside. So a couple of recent articles have come out by Zoopla. Zoopla has one of the largest UK portals for property sales through estate agents, similar to Rightmove. So just a couple of things. New sales activity in the housing market is holding up the last few weeks. High mortgage rates obviously have affected the market, but they do not hit all buyers equally. I remain hopeful that borrowing costs will be lower as we start 2023. So number one, I'm hopeful mortgage rates will start to fall back down soon, already since Rishi Sunak became Prime Minister and reversed tax cuts in the mini budget. We seem to have restored slight confidence in the market. Interest rates are still high, but we are seeing more lenders such as Nationwide increase their borrowing availability and at slightly reduced rates. So borrowing costs are starting to fall for government debt and all important interest rates that set the cost of fixed rate mortgages. Mortgage rates for new borrowers remain over 6% flat, but I believe there are very early signs that this could start to fall back further in the weeks ahead. It's important that we look at the outlook of the UK housing market next year, because it really does hinge on the level of mortgage rates for buyers entering the market from January 2023 onwards. Our analysis and data suggested mortgage rates of 4% were manageable for most buyers, but as a stress test, rates reaching 5 or 6% or higher would certainly then be the tipping point when the likelihood of some local prices start to fall. And as a stress test, you want a cash flow positive investment, so 6% sort of creates a position where you can stress test whether you can afford the debt or if the renter, your tenant, can pay your debt as well on your mortgage if you're a buy-to-let investor. So looking at what really matters now is the outlook for inflation, food, gas, energy, lots of things to consider. As soon as we get signs that inflation is starting to peak, financial markets should start to take a very different outlook on borrowing costs. This will start to reduce the cost of a 5-year mortgage rate, which accounts for more than 60% of all new loans. So it's early days, but I remain optimistic that mortgage rates will be lower than they currently are as we enter 2023. However, home buyers need to realize that subprime, sort of 2% mortgage rates are a thing of the past. Cheap money over the last decade, 4% is likely to be the new normal for mortgage rates moving forward, unfortunately. So, number two, there are minimal chances of negative equity. The reason for this, there's strong UK-wide house price growth over the pandemic has added to the equity buffer for homeowners. So some people have seen 15 to 20% rise in prices. Of course, this is also because the properties over the last 5-6 years have seen some capital growth. So there's a huge equity buffer to absorb any reductions. Even if there's a drop of maybe 5 or 10%, people are still up, landlords who bought a few years ago are still up on their investments. So when we calculate a nationwide 15% reduction in house prices from today's levels, it results in a very few cases of negative equity for mortgage sales up to the end of 2021. This highlights how UK housing market has become increasingly equity driven, and it's much less dependent on high loan to value borrowing over 90%. So those are a couple of points, in terms of negative equity. I think because prices have gone up to a fair amount, a lot of people won't, they'll hold on and ride through the next few months, and hopefully they'll still be up on their equity. Number three, new sales are still being agreed despite uncertainty. Looking back over the last few weeks, activity, home buyers and Zoopla, we see that interest from new home owners continues to weaken. It's down a further 8%. Those who haven't managed to arrange cheaper mortgages are stepping back from the market, creating a sense that Christmas seasonal slowdown has started a little bit early. However, sellers and buyers continue to agree new sales across the UK. The rate at which new sales are being agreed is of course slowing down, 25% on this time last year, but sales overall have not stalled. The market's still moving, there's still demand. Sellers and buyers continue to agree new sales, and mortgage rates are important for many buyers, but life-related decisions are also important and other pressures. A lot of people don't want to be stuck in renting a property. they aspire to own a property or a home, they may just have to downgrade on the expectations and buy something maybe a bit smaller or more affordable that they can afford within their budget planning. So on to the next one. The other reason I believe that I remain fairly optimistic is there's 30% of sales are cash buyers. High mortgage rates are deterring buyers who need a large mortgage or maybe don't have much deposit to buy a home, but not everybody needs a large mortgage. We're seeing a lot of investors from overseas still, the Middle East, South Africa, and different countries buying into the UK because they still see it as a better option for them. And other countries actually have even higher rates of like 10-11% and their own problems. So UK is still deemed economically, politically fairly stable compared to many other countries. And because of the housing undersupply, that's what's driving the demand for rentals, rental inflation, and buyers looking for rental yields. So just on to the next point. So point number 4, 30% of sales are cash buyers. Higher mortgage rates are deterring buyers who need a large mortgage to buy property or a home. Not everyone needs a large mortgage. In fact, 3 in every 10 home sales in the UK were paid for in cash last year, according to Zoopla. A further 20% of buyers use smaller size mortgages, and the increase in borrowing costs will be much smaller and less of a disincentive to move for them. So really, cash buyers account for almost around 40% of sales in the southwest, but in London, where prices are highest, less than 1 in 5 sales are paid without a mortgage. Obviously, areas like Liverpool, Manchester, Birmingham, smaller towns, you can actually get good deals, and you get a lot of investors who buy cash who are looking for an income and a passive income and a decent rental yield. So we have seen the proportion of cash buyers increase over the pandemic, with more moves by older homeowners, so people planning for retirement and they've already built up quite a lot of equity in their current homes. Those who have paid off their mortgage, over half of all homeowners don't have a mortgage at all in the UK, in fact. And then you've also got your overseas buyers from the Middle East, South Africa, Southeast Asia, who are investing in the UK. They've got their own internal or political problems in their own countries, so they are looking to put their cash somewhere. They're also planning for retirement, and they tend to look at the UK as quite a safe and stable market to put cash and buy properties cash outright. So this all sort of adds up to say that, there is some stability still in the market. The market's still moving. We're still seeing deals happening. In fact, we had a record month in October in terms of sales. November slowed down slightly. So most people buying a home do rely on a mortgage. The increased rates is important for the UK housing market outlook. It will be interesting to see what happens in the next few weeks and months. However, the market fundamentals are there in terms of there's a demand for housing, there's a shortage. Buy demands may change. So yes, just to summarize very quickly, the key takeaways really is it's early days. I remain optimistic that mortgage rates will start to be a little bit lower as we start 2023. Number 2, there are minimal chances of negative equity after strong post-pandemic price growth. Number 3, sales are still being agreed in the last 2 weeks. Or last few weeks, as those keen to move with cheap mortgages in place continue on with their sales, but obviously this is going to go up in the future. Number 4, higher mortgage rates do not hit everyone. 30% of sales within the market are cash. A further 20% are with smaller size mortgages. And number 5, for now, it's like Christmas has come early for the housing markets, with slightly low activity from new buyers in the aftermath of the mini budget. So look forward to seeing what happens over the next few days. I'll keep you updated. Please do click and subscribe the link below. We have a free UK property guide. We'll give you the latest market news, up-to-date information. You can subscribe to our Investor Insight group, and we also offer free educational webinars. So please subscribe, like, share this video if you found it useful, and have a great day. Thanks.